You are listening to The Investor Way with Sam Ball and Jonathan McEwen. If you enjoy the show, please subscribe and follow us on Twitter at TIW Tweets.
Hello, welcome to The Investor Way with me, Sam Ball. It's the 23rd of July, 2024, and I'm joined by my co-host, John McEwen. And in this week's episode, we'll be discussing Burberry, Ocado, Frasers, Trustpilot, Aston Martin Lagonda, and our US company of the week is Neflix. John, do you want to start us off with Burberry?
Yes, so Burberry had a Q1 trading statement out, which was rather unexpected, with first quarter revenue down 20%, ignoring the impact of exchange rates, which was worse than analysts had been expecting. And the double-digit declines were seen across all of the regions as the market remained challenging. As a result of the current trading weakness, dividend payments for this year have been suspended to help maintain the balance sheet. And Jonathan Akeroyd has stepped down as chief executive with immediate effect. And Joshua Schulman, who has experience at Michael Kors, Coach, and Jimmy Choo, has been announced as the new chief executive. And if the current trading weakness continues, the group is expecting to make an operating loss for the first half of the year, and full year revenue is expected to fall by around 30%. On the news, the shares were down over 10% in early trading. In terms of valuation, Burberry has a market cap of just under £2.6 billion and trades at currently 15 times forward earnings with a 10-year average of 20 and has a prospective dividend yield of 2.7%. I think these results, this trading statement, clearly very disappointing. I think we've debated some of the merits and drawbacks of Burberry over the last couple of years. And I think initially, post-COVID, it had struggled, and then there was a period where we saw revenue growth, and it appeared to be well on the road to recovery. And then with the slowdown in China predominantly, and with sort of tempering of the market overall at the sort of luxury end, Burberry's been particularly badly hit. It hasn't traded at huge valuations, certainly not compared with LVMH. And I think personally, I've seen some signs for optimism in Burberry. And I think one of the things that, does draw you to it is that it doesn't command that really premium valuation, and that it's got it's popular in Asia, and it's got that sort of longer term Asian growth story on the back of it. However, I think, looking at that valuation, you're kind of seeing, it come to fruition why it was more lowly valued, and that actually the strength of that brand is far, far weaker than what's in the sort of LVMH stable. And, hence why you sort of get what you pay for in some senses with that. And yeah, I would be staying well away from Burberry. It was on my watch list for a time, but now I'm just leaving it well alone. But I think it could be, really difficult times to come for the group.
Well, the historic dividend yield's not bad, is it?
Yeah, the historic dividend yields, yeah.
Would have been like a tobacco yield, that, but
yeah.
Really, really disappointing, these results. We like covering LVMH a lot, but we've also done Guess, we've done Ralph Lauren. So we have done a couple of other similar brands. I don't recall covering any other luxury retailer that has put out a trading statement as horrific as the one we've just seen from Burberry. There's not really much to be optimistic about, and it just feels with Burberry almost like it's one step forward, two steps back. And I remember a few years ago when I interviewed Flosser, he'd said that he used to own Burberry, and he felt like, there was always this excitement around the Asian growth and stuff, and it just never really seemed to get any sort of momentum. And I think we've seen that in the time we've covered it as well. Yeah, just really, really poor. I think the CEO leaving kind of suggests they almost lack direction as well. Maybe they'll be fine. They probably will be fine. It is a good brand. If they turn it around and get back to where they were, it's probably pretty cheap. But I think you do have that risk that you just don't have with LVMH, where it's just the Burberry brand. So if the Burberry brand doesn't come back into fashion, And I don't think they can entirely blame economic factors because we've just not seen anything like this from any of the other luxury retailers. So I don't really accept their argument that it's basically all economic factors outside of their control. There's got to be some kind of mistake that's been made, whether it's in terms of like the branding or the pricing or something else. For me, I just think whatever this is, whilst it's a fixable problem, it is very, very concerning. I guess that's why you're getting it at PE under 10. But the problem is, maybe it can get back to where it was, but in terms of long-term growth, I just don't see it based on what we've seen. Whereas if you compare that to LVMH, it's just in terms of it's consistently putting up the numbers, and I just don't think we've ever had any consistency from Burberry.
Do you think Frasers might take a nibble?
Is it a bit too international for Frasers though?
Well, I don't know.
They only really like the UK high street, don't they?
Well, we'll see. I'll come on to some of what they own. On to Ocado then.
Yes. So Ocado, they have come out with their first half results, and revenue was up 12.6% to 1.5 billion, which reflected growth in all business areas. The technology solutions business saw the fastest rate of growth, which was up 21.8% due to more installed modules and inflation-based contractual price increases. Ocado Retail saw revenue rise 11.3% to 1.3 billion, and this was helped by increased active customer numbers, which rose 8.1% to nearly 1.04 million, while price increases were a much smaller contributor. Underlying cash profits jumped from 16.6 to 71.2 million, largely due to improved profitability in the technology solutions and retail businesses. Smaller gains were seen in the logistics business. Free cash outflows improved from 305 to 145 million outflow, and net debt, including lease liabilities, grew from 900 million to 1.2 billion. Full year revenue growth guidance has been maintained, which suggests that the technology solutions and retail figures will slow down in the second half, but the outlook for cash burn has improved. The shares rose 17.5% following the announcement, and the business trades at a forward price to sales ratio of 0.9, and that compares to a 10-year average of 2.8, and there's no earnings or dividend. In terms of the share price, it's starting to recover a little bit. It is up 36% in the last month. However, it's still down 77% over the last 3 years. I think these results, I guess, are quite encouraging. I think we've said before, the most exciting part of the business is the technology solutions business, and that seems to be doing quite well. The issue I have is, even though these results have improved, they are still burning a lot of cash. So yes, it's got better, but the free cash outflow is 145.1 million. If they don't start getting some serious money in the next couple of years, they're going to have to dilute the equity holders. So I think really interesting product, but as a business, just same issue. In terms of revenue, these are quite good results, especially compared to what we've been seeing for the last maybe year or so. But it's still just so capital intensive that there's just never any cash available is the problem. It just always seems to be burning it. So not a business I'd ever be interested in just because of how capital intensive it is. John, what about you?
Yeah, I wouldn't have a lot more to add, to be honest. I would just second that, and yeah, wouldn't be one for me. But on the surface, and it is encouraging, but I think there are all of those other underlying factors as to why it wouldn't be investable for me.
All right, should we move over to the Ashley Empire then?
Yeah, absolutely. And I think this is one you did you own this at one point, Sam?
I had Sports Direct.
Okay,
That's
fair
before
enough.
it was Frasers Group.
Yeah, so for anyone who doesn't know, it essentially is what Mike Ashley's retail group became from what was originally listed as Sports Direct. It's now called Frasers, and chief executive is his son-in-law, but it owns brands like Sports Direct, House of Fraser, Flannels, Evans Cycles, Everlast, Jack Wills, Slazenger, Sofa.com, USC, Game, Carrymore, Agent Provocateur, and over 30% of Hugo Boss, and building stakes in ASOS and Boohoo. And that's not an exhaustive list. So it kind of gives you an idea, but a lot of the UK high street in there. Anyway, the group had their full year results out, with full year revenue falling by 0.9% to £5.5 billion, as House of Fraser store closures and weakness in the premium lifestyle more than offset a strong performance from Sports Direct. An additional week in the prior accounting year also negatively impacted the comparisons. And Frasers' profits from its retail trading operations were down 0.9% to £738.9 million. However, the headline profit measure, adjusted profit before tax, improved by £63 million to £544.8 million, which was at the top end of guidance. And this was helped by a sharp fall in non-cash impairments to the value of the company's properties. Free cash flow improved from £327.2 million to £470.9 million as a result of improved cash generation. Net debt, including lease liabilities, came in at £1.1 billion. Full-year underlying pre-tax profits are expected to grow to a range of between £575 and £625 million. And the board again decided not to pay a final dividend, but it does have share buybacks in operation totaling £126.4 million. And the shares were up 10% on the results. In terms of valuation, Frasers has a market cap of £3.93 billion and trades at 8.4 times forward earnings, compared with a 10-year average of 14.6. And it currently, as mentioned, it doesn't pay a dividend. I thought these were a very good set of results. I think the strategy seems to be working in terms of moving more up market in what can be a cyclical industry. I know it's been more difficult in that higher end of the market more recently, but the margins have been much better. And I think it's interesting, some of the partnerships that it's formed. It's now named as a key partner by both Nike and Adidas. And it's also selling some more upmarket outdoors brands like North Face and Salomon. So I think that's all working well for it. I think there are probably always going to be corporate governance concerns about it with the Ashley family and how they've traditionally run it. But it does overall, I think, seem to be making some quite smart decisions in terms of the overall strategy of the business. Not sure what to make of ASOS and Boohoo. Obviously quite opportunistic, as the share prices have been very weak with their poor performance. And also, I think Hugo Boss, again, that has come down, as with the rest of the luxury market, and Frasers have been expanding their stake in them. I probably wouldn't invest in it. I think I would rather just pay up, go for LVMH, and just think that you've got incredibly high quality brands which are worth paying up for, and just leave it there and sleep easier at night, rather than the strategy that Frasers are pursuing, which I think in many ways it's got some value elements to it, as well as trying to kind of capitalize at the other end of the market on the more premium, higher margin sectors. But I would probably just stick with those really strong luxury brands and just pay up for LVMH. Sam, what are your thoughts on Frasers as a company, and then obviously these most recent results?
I think the results are pretty good. And I know the revenue's fallen slightly, but if they've been closing stores, that's obviously part of a strategy just to improve the efficiency. And that has shown in the profits, where they've gone up. So they're obviously getting rid of the less profitable stores, or the unprofitable stores even. So I think as a strategy, it seems to be working fine. It does say here that they have been trying to push into luxury with flannels and, is it Geeves and Hawks? I don't know what that is.
Yeah.
So maybe they could go for Burberry, but I think Burberry would have to fall quite a bit more before they actually pulled the trigger, because Burberry's market cap's £2.5 billion, and I think Frasers is sort of 3.5 to 4. It's just under 4 billion.
Yeah.
It'd probably be a bit too big for them to swallow up at present, although not if Burberry carries on the way it's going. Yeah, I think the strategy's fine, but I do agree. I take your point that, if you do want to increase your luxury exposure, maybe you shouldn't buy Frasers Group. You're better off just buying something like LVMH. But I think they're not in the most glamorous end of the market, but they've got a strategy and it works well for them. So fair enough. But I don't think I'd want to be at that sort of value end of the market, especially, having been burned with Boohoo, I wouldn't be keen to own it again via Sports Direct. So for me, it's just not a business I'm interested in, but I don't think they're doing a terrible job running it, that being said. And I think the valuation is pretty reasonable, considering that although there might be governance issues, I think it is well run.
Yeah. And it's interesting on that point, because I think if we looked back to the share price when you did own it, you would have done rather well out of it if you'd held.
Yeah, I would have done. Yeah. So when did I've had it? I want to say like sort of 2016, 2017. I got it.
Yeah. Sounds about right.
Yeah. So I had it for about 3 years or something. So I think
Oh, did you have it for that long? I hadn't realised. I thought I thought it was more of a 3-month job.
no, it was 2 or 3 years. I think I had it. I think I had it for at least a couple of years. I don't think I ever did loads. It was maybe flat or up 10% or something. But then
Yeah.
you can probably tell by when I sold it when you look at the graph because it really starts taking off in about 2019. So literally not too long after I was sold. But yeah, probably done better than whatever I put the money into. So that's life.
Always
But
difficult. Yeah,
it is always
absolutely.
difficult, but it's
Absolutely.
life.
Fine.
Shall we move on to Trustpilot?
Yes. So we've covered it. Is it a couple of times now?
We've done it at least once.
Yeah.
I think it might only be once actually, but we have done it at least once before. So for anyone not familiar, it's the review website, and they then make money by basically getting the companies that are getting the reviews to sign up, and they will pay for the data of the people who are leaving the reviews, which is basically the customers. So I think quite a good business model, really, because you would imagine that data is particularly valuable. So Trustpilot, they've come out with a trading statement on the 6 months ended 30th of June 2024, and bookings are up 19% for the half to 118 million. Annual recurring revenue is up 18% for the half to 211 million, and revenue is up 17% to 100 million. And these figures are all in dollars, by the way. And they've said that the improvement in bookings and revenue reflects momentum across all focus markets and significantly improved retention in North America. UK bookings are up 19%, Europe and rest of the world 16%, and North America at 23%. Last 12 months net dollar retention rate increased from 99 to 101%. And they've had strong cash generation with net cash of 76 million, down slightly from a net cash position of 92 million a year ago, but that's after completing an initial 20 million pound share buyback in the half. And they've also got court approval for future share buybacks in line with their stated capital allocation strategy. Adrian Blair, CEO's statement, he said, as we look ahead, we remain confident in the significant growth opportunities available to us in our focus markets of the UK, US, Germany, and Italy and beyond. And they have over 260 million reviews and 57 million monthly active users with 117 billion annual Trustpilot impressions. In terms of valuation, it is still expensive. It trades at a P/E ratio of about 155. It's only just started generating earnings, so the PE is not that useful. In terms of the market cap, it's about 856 million, and the shares are up 177% in the last 2 years, but they're still about 50% below the peak after it IPO'd in 2020, or shortly after it IPO'd. My thoughts are pretty similar to the last time we covered it. I think it's a very good set of results. That's partly why they've put the trading statement out. I like the business model. I think that data they're selling is really, really valuable. I don't know how big it could get. I don't know what the potential market size is, but at a market cap of 850 million, you'd think there would be some room for them to make some quite decent operating profits at some point in the future. So if you look at it in terms of market cap and the potential they could make, maybe from that business model, there could potentially be an argument for it there. The other issue is I don't know what the competitors are like in overseas markets. I know the revenue is pretty diversified, and it does seem like they're making good sort of leeway in America, but I don't know whether Trustpilot's universal or if it's just UK or not. It's just so expensive. I know it's still below the IPO price. It's starting to turn a corner with profits and stuff like that. But I think one thing that I find quite concerning is that they're already buying back shares, and that although I think this is a business that could potentially have very high operating margins in the future, kind of like a Rightmove or an Auto Trader, the issue is if they're buying back shares already, that kind of suggests that in terms of the return on capital, it might be very high, but if they don't have the opportunity to reinvest that capital, can they continue growing it at the same rate? Maybe they can, because it's just more and more people, they just up the prices, they have more businesses subscribing, and they can do that with the existing infrastructure. But I just think there's a bit of a question mark with the growth, although that is caveated by the market cap still being relatively low. It's a business I like. I think it's good enough for the watch list, but I'd need to watch it for probably another year or two before I considered pulling the trigger. And I'd rather see it grow a bit more and kind of grow into its valuation so that PE comes down a little bit, even if I maybe don't get it at the best valuation. What about you, John?
Yeah, I mean, I think it's a very interesting business and huge potential. I certainly wouldn't feel comfortable paying up for it where it is at the moment. And yeah, like you say, knowing probably a bit more about the industry and seeing what some of the, what I would expect larger US competitors are, because you may find that if it tries to more aggressively expand in the States, that it's halted and retreat, and then looking at how much room for growth there actually is. And when it's trading at the sorts of valuations it is, then it's got a long way to fall there. So I think it'll be a very interesting one to follow. I was going to ask you, is it listed? Is it an AIM listed company?
No, it's FTSE 250. But
Okay.
I think it initially dropped out of the FTSE 250 for 2 or 3 years when the share price
Okay.
tanked. So there's one competitor called FIFO, there's
Okay.
Yotpo, Reviews. I don't know if maybe they are sort of the dominant one even in the US.
It seems like a small market cap for the sort of industry, and like
It's a small
if they are the
market. It's
market.
just a review website, isn't it? I guess
Suppose.
they've only just started monetizing it. But yeah, I
Mm,
agree. It's a small market cap. But if they are dominant everywhere, I don't know. Maybe we wouldn't have heard of the US one, but I kind of suspect maybe now having looked at it, I do wonder if maybe they are the number one in the US because
mm,
they're struggling. I've put US in my search and genuinely struggling to even sort of find the names of competitors because I guess there's only so many
interesting.
websites people will go to.
Yeah.
Here we go, top 10 Trustpilot alternatives and competitors in 2024. Capterra, never heard of it. Shopper Checked, Yotpo, Bird Eye, Reputation, Nice Job, Review Trackers, Review Inc, Power Reviews, Yelp. I've heard of Yelp. Review Buzz. I mean, I've just never heard of these.
Yeah.
You'd think you would have done, but I think it's maybe a low market cap, just because there's maybe question marks about how big the review market actually is. Although I do think, if they've got all the US review data, that's incredibly valuable. So then you get into the argument of, well, do you almost take a punt on it when it's got a ridiculous PE because the market cap's so low? If they can get the value out of that data that might be there. But I think I'd still rather give it a year or two, let it get a few more periods of results under its belt, and if you end up paying higher, but there's more proof of concept there, I'm quite comfortable doing that. What about you?
Yeah. No, I would say so too. I don't like to pay up for some of these quite early, more speculative tech type companies. So yeah, it wouldn't be naturally one for me at the moment, certainly.
No. Should we move on to a much cheaper business then, which maybe will be one for you?
Sam, I don't think I try to put the emphasis on some quality, and Aston Martin Lagonda, since it floated the most recent time a few years ago, has really been struggling, and it's well below. I'll have to have a look at the chart, see how far it's fallen since listing, since the IPO. So the revenue fell by 10% to £268 million. And this reflected a 26% fall in volumes, driven by a 63% fall in SUV models as changes to the portfolio were made. And this more than offset a 12% rise in sport and GT models and a 150% increase in higher margin specials. Average selling prices, excluding specials, were down 2% from the same time last year at £167,000. And operating losses widened by around 15% to £59 million, reflecting an increase in operating expenses. Free cash outflow increased to £190 million, up by £72 million from the same time last year. Net debt grew by 20% to £1 billion, and despite the performance for the quarter being below expectations, guidance for the full year remains unchanged. and this includes delivering positive free cash flow in the second half of the year. And shares were down around 7.5% in early trading. In terms of valuation, the group has a market cap of just under 1.25 billion and doesn't currently have earnings, so there is no price to earnings ratio. I thought these results were really disappointing. I suppose it's partially baked in by the market in that the results, the shares only fell by 7.5%. But this is a business that I would just never own. I think it's gone bust something like 19 times in its history, and I'd just be staying away with a barge pole. It's just not one I'd ever consider. I think it's the cars look fantastic, but I suppose the problem is people aren't buying them, and they're not able to charge as much as well. So yeah, it's not one that I'd consider investable. Sam, what are your thoughts on this set of results?
Pretty poor. I don't know if they're the worst set of results we've seen from Aston Martin, that being said. Yeah, 26% fall in volumes is really, really concerning. It's just burning cash, the debt's going up. I suspect we'll be sat here in a few years' time and you'll probably be talking about Aston Martin and how it's gone bust 20 times in 2019. I think that is the direction it's heading in, unfortunately. In terms of the share price, it's dropped. I don't know if it's since IPO, but since in the last 5 years, the share price is down 97.93%.
Oh,
And it was trading at over £50 a share 5 years
gosh.
ago, and it's now
Gosh.
£1.48. So,
Oh,
and but the thing is, you could still lose a lot of money if you buy it now, because if it goes
yeah.
bust, you can still lose 100%, even if it drops 98% before you buy
Yeah.
in. It's just,
Yeah.
I just wouldn't touch it. I think it'd be, yeah, I think you'd need to see something that I must be missing in
Yeah.
order to consider this. I don't know why I'd even look at it further. I think, unfortunately, it's probably just going to continue to go bust. It's kind of like
Yeah.
Argentina was a company, isn't it? So.
I suppose, and one of the reasons for covering it though is that it is just an iconic British brand, and that probably being the main reason.
Yeah, it's interesting to follow, but my God, I'd never buy shares in it.
No, fair enough. Fair enough. Okay, on to our last company then.
Yes, so Netflix, a business which probably needs no introduction, they have come out with their Q2 results, and they've reported a 17% rise in revenue to $9.6 billion, ahead of the estimates expectations of 9.5 billion. Operating margin rose from 22 to 27%, which helped operating income rise 42% to 2.6 billion. I guess it's because they've not really, I guess those subscribers are just flowing straight through to profit, aren't they, really? Performance was driven by the 8.05 million, which was 16.5% growth in subscribers over the quarter. And within that, subscribers to the ad-supported product grew 34%. Free cash flow fell from 1.3 to 1.2 billion, and net debt stands at 7.3 billion, which isn't really concerning at all, given that that's 1.2 billion of free cash flow a quarter. So it's less than 2 years free cash flow, the debt. For the third quarter, revenue is expected to grow 13% year over year, and full year revenue is expected to grow 14 to 15% with an operating margin of 26%. The shares were broadly flat in after hours trading, and the ad-supported user base is expected to reach a scale in 2025 that will make it the go-to place for advertisers. And with a huge store of user data, those ads could be very, very valuable. In terms of the valuation, the business trades at a forward PE of 31, and that compares to a 10-year average of 95.5. My view is it's a really fantastic business. However, we've covered it for the last maybe 12, 18 months, and it's had a little bit of a wobble, actually. And it's now started to get back to the results we were used to seeing prior to that. But I think although it's recovered from its wobble and it looks like it's done really, really well, my concern would be that wobble to me indicates that I think this is now going forward going to be a cyclical business. I think you're going to see very large swings in the revenue because I think if people want to cut back in maybe a poor economy on discretionary spending, they might cut the Netflix. I also think that depending on how popular the new releases are, that will affect it. So for example, if they don't have a Squid Game every year, that could cause problems, and you might have years where the new releases don't go as expected, and years where they've got 3 or 4 shows that everyone wants to watch. And I think the subscribers will turn on and off with that. So I just think going forward, it's going to be much more cyclical, and you might see sort of 17% rise one year and maybe a 15% drop the next. I think that is going to be the norm with Netflix now, and I think that this wobble is that we have just seen them recover from, I think is the start of a trend, not necessarily a downwards trend, but I just think it's going to be a much more cyclical business because it's already got so many users. I think the law of large numbers will start to take effect for Netflix now. I could be wrong, but I just think with that in mind, and I think even if I am wrong, it's still a very legitimate concern to pay 31 times forward earnings for this business at this scale after what we've just seen. I mean, it's not like you're getting it at some kind of discount or anything because of that cyclicality. It just seems to have basically recovered to where it was prior to the little wobble we've seen over the last 18 months. So I think it's a business that's performing really well, but I wouldn't be interested in it. What about you, John?
Yeah, I mean, it's a huge company, and it's one that I'll definitely own as part of a world tracker. But buying it as an individual stock, I would be nervy for similar reasons. And the amount of capital expenditure to produce some of these shows, and if they are a bit of a flop, and if there are difficult times, I think it has been shown that people will just switch off. And it's one of those services that's very easy to switch off for, either if times are difficult economically or if the content is lacking. And, you can flick between whether it's Disney or multiple other platforms that have since come up. I think historically it was just Netflix, and it was all really post 2008. So times were gradually becoming easier, and I think that's the environment that we got used to with Netflix and the growth. And we've seen actually when things have been tested a little bit more recently, it hasn't proved as resilient. So yeah, I don't think I would be paying up 31 times earnings, although I appreciate I sort of own it, in a passive sense, and I'd be much more comfortable having it as a small part of that.
Well, I think as well, I don't think they've got a moat anymore. I think they
Mm,
maybe did 5, 6. Well, I guess if it's gone, was it ever there to start with? But
well,
I don't think they have a moat. It's just because what would the moat be? I mean, I think the moat used to be for a few years that they were able to outspend everyone else in terms of the content
yeah,
production, but it's harder to outspend sort of Disney and Paramount and sort of Amazon and these sort of, it's just so much more competitive than it was. I, I think in terms of the moat, I don't think it's dissimilar to ITV. Now,
yeah.
Netflix is a much better business than ITV, but in terms of the moat, it's basically sort of the quality of the content and what people are enjoying now. I don't think it's that dissimilar a business. It's just a different platform that it's being consumed on.
Yeah, and I think if you were looking at Netflix, then you might take a more serious look at Disney and some of the IP that it owns, and also sort of on a valuation basis too. I think there's a lot more going for Disney than there is for Netflix, and it would cost you less too.
I would agree, although we are slightly biased.
Well, yeah, that's our 2 cents on it, as it were.
So, of the 6 businesses we've covered this week, then Burberry, Ocado, Frasers, Trustpilot, Aston Martin Lagonda, and Netflix. Which do you like the most and which do you like the least?
Oh, well, I think Aston Martin's last by some considerable distance. Yeah, I I'd probably go for Frasers, I think, of the choices this week, and it's not expensive. Be joining forces with Mike Ashley and his family, but actually you might do all right out of that. They seem to have done well historically.
I think I'd probably do the same. I think I do think Trustpilot looks the most interesting, but it's just not at the valuation at which I'd want it at the minute. So if I had to buy one today, I think it probably would be Frasers,
Yeah,
without being boring. And I think last would probably be Aston Martin, but that's quite an easy last.
yeah.
I think I'd probably prefer Ocado over Aston Martin.
Despite it having the coolest brand of all of those
Well, yeah,
companies.
yeah.
But it does show that doesn't make a good investment.
No, it's not everything, is it?
No, absolutely not. Okay, well, thank you very much for listening, and we will see you again next week.
See you next week.
Thank you for listening to The Investor Way. To get in touch, please follow us on Twitter at TIWTweets. This podcast is for entertainment purposes only and does not constitute financial advice. Neither Sam nor Jonathan are financial advisors. For investment advice, please consult professional advisors.